stock which hasn't really recovered is KPIT Tech. Yesterday as well, after the earnings, the stock saw a bit of a cut, despite the fact that the company had maintained their overall broad guidance of 18 to 20% kind of 22% kind of growth with a margin profile of 20.5%. And the reason was because the commentary on the mobility segment was a bit weak. In fact, let's try and decode that further with the management who's joining us on the show right now. Mr. Sachin is joining us from the show on the show. Sachin Tikekar, the President and Joint MD at KPIT Technologies. Sachin, hi. Good to be speaking with you. Anisha this side. Well, while you've maintained the overall guidance at 18 to 22%, now you're talking about achieving the lower end of the range, which means that the ask rate for the next couple of quarters is just 1.5%. And I'm saying just 1.5% because the last 4 to 5 quarters you had spoiled us with that 4, 5, 6, 7, 8% growth that you were delivering. Why this sudden slowdown over the next couple of quarters?
So thanks for having us today. Let me just take a step back. At the beginning of the financial year, we were one of the first ones to provide guidance, and there was a reason why we gave a broad range, 18 to 22%. Usually it's a couple of percent points for us, but we decided to do that because we knew that the automotive industry was going through some structural changes for 3 or 4 key reasons. One is, I think, the pressure from the Chinese OEMs who are coming up with incredible vehicles at much lower cost point. Second is the whole macroeconomic scenario and, the geopolitical things that are panning out. So we knew that it was going to be a little bit of a turbulent year, and that's why we gave sort of a broad range. And we have to say that we have delivered the first half of the year has been pretty good, well in line with our expectations. And we knew that the second half was going to be slightly, there was going to be a little bit of turbulence. What is actually happening is many of the European OEMs, specifically the ones in Germany and France, they're trying to figure out what this means to them from the long-term perspective, right? Which markets they want to play in, how do they remain competitive, hence which kinds of programs they pick and which kind of programs they don't pick. The good thing for KPIT is we are part of all of those conversations. And essentially the bottom line is they'll have to do 3 things. A, they have to reduce the cost of their vehicles substantially. Secondly, they have to reduce the time to market from typically 5 years to less than 3 years now. And they also have to figure out who their consumers are going to be in future, in which markets, and what kind of features they want, right? So while this has all been done, the good thing is we are working with all of them. So we are in really great conversations with them. It's just that there is a shift in the strategy, and hence the work that we are to start with them is postponed a little bit. So that's one part of the reason why the H2 is going to be softer, comparatively speaking, to H1. And second part, for the last 6 months, we have started to work with them to actually reduce their costs. So what we have done is the bulk of the work that we are doing, we have actually moved it to lower cost countries. That has also impacted the revenues for us to some extent. And that's a good thing for our clients, and it's a good thing for KPIT too, because we've been able to hold on to our margins or even better them while we were going through this transition.
Sure. Sachin, I just wanted to pick on a couple of points that you said that the French and German car makers have turned a bit more cautious on their spend, and you're saying that it's a postponement of spend. Does that mean that this is only going to be transient, or do you see this getting a bit more protracted, let's say 3 to 4 quarters? What's the sense that you have right now of this delay in spends?
So our view is these spends cannot be postponed any further. I think, there is tremendous pressure, and, programs need to get started in their new avatar, and there has to be consolidation. And those are the conversations that we are having. Now, when you have long-term, meaningful, big conversations, they take a little bit longer than short-term conversations. So we do believe that it's a question of 1 or 2 quarters and not anything beyond that, because beyond that, I don't think many OEMs can afford to push these programs out by too long.
Right. Very good morning to you, Sachin. This is Shailos joining in the conversation. If you could talk about the trend of offshoring of deals. You see this continuing going ahead as well?
Absolutely, absolutely. If you look at our work, the composition of fixed price has gone up substantially, not only year on year, but also quarter on quarter. And this is one way we think that we can reduce the cost of the OEM substantially. Hence, this has been a focus, and we believe that it's in the interest of the OEMs to do that. And fortunately, by having long-term relationships, we have built enough comfort and we have demonstrated confidence that bulk of the work can actually be done from the best cost countries. So we see the trend to continue going forward.
Very specialist company, and when we've interacted with you, you've said that look, what's happening in the world, it doesn't impact us because we are a automobile technology solution provider. There is boom in EV, there is boom in automobile sector. Look at Tesla's indication yesterday. If the reality of the business which you represent is different, looking at the global data point, then why are you feeling the heat?
So in all honesty, I wouldn't call it quite the heat because looking at all what other tech companies are announcing, I think we are still 2 times or 3 times their growth at this point in time, and hence we remain bullish in spite of some of the challenges that are being faced by some of the OEMs. And it's a mixed bag, in all honesty. Not all OEMs are facing the same kind of pressure. There are markets like US that are protected by having 100% tariffs on the Chinese vehicles being imported in the US. So for now, the Teslas of the world or some of the other OEMs in the US are feeling less heat at this point in time. However, some of the other OEMs are not as fortunate. So they are facing a lot more heat. So to us, it's just a question of seeing how to help our OEMs reduce their cost of the vehicle and make them competitive or keeping them competitive rather. That's really the reconfiguration process that we are going through, rather than calling that we are under any pressure, so to speak, in all honesty.
Not facing the heat, Sachin, but the street is now expecting that given all of this and given what you're talking about, the mobility segment and the couple of quarters being weak, the exit rate for FY25 will be weak, which means for FY26, the growth rate is going to be sub 15%. I know you can't call out a number yet, but directionally, will it be way off the mark, sub 15% growth for FY26?
You're absolutely. It's way too early to talk about it, and maybe in January we can discuss a little bit more about the guidance part. However, let me reiterate the part that the deal closure has been very strong, stronger than the previous quarters in Q2, and we are also winning a lot more. The question is, when do we get started with some of these wins? There are also some significant conversations of mega engagements that are being structured at this point in time. So we believe that at some point they need to come to fruition, and that will sort of propel our growth getting into FY26. So we remain fairly optimistic as far as FY26 is concerned.
Okay, remain optimistic about FY26. I think that is something that the street would like to hear. But before I let you go, quick couple of questions, Sachin. Of course, the fundraise that you have kind of taken the approval of 3,000 crores. Could you give us a bit more color in terms of the timeline of the raise and the acquisition? And secondly, on the margin front, is there an upside risk to that 20.5% guidance?
So first thing first, so let me answer the second part of the question. The margin, what we said in our commentary yesterday, that will be closer to 20.75 than 20.5. So, we'll be on the higher end of the guidance when it comes to the margins. That's point number one. And that goes back to my comment about more of moving work more to best cost countries, right? That's also this is part of the reflection of that. Now, the other question, sorry, if you can just
acquisition and fundraise, Sachin. Acquisition and fundraise.
Yes, the QIP part, absolutely. So you know how it is with the M&A stuff. You can't put any timelines to that. Essentially, what I could tell you is the areas in which we are looking for any kind of acquisitions and any kind of strategic engagement. So one is our investments in off-highway and trucks. So anything that would strengthen our offerings and position in off-highway and trucks, that would make it in line with, the kind of positioning that we enjoy in passenger cars. That is definitely an area of interest to us. Second, we are also trying to learn a lot from the automotive ecosystem in China. So we are looking at partnerships, potential partnerships in China. That's the second area. And the third area is the whole cost reduction part of the vehicle. Today, we reduce the cost of the vehicles by providing software and software integration to the OEMs. But I think in order to reduce the total cost of the vehicle, I think we need to sort of increase our offerings. So something that would complement our existing offerings, that is another area of interest to us. And last but not the least, the increased regulations across the geographies, especially in specific countries, also provides an opportunity for us to look for any kind of M&A. So, these are the 4 areas that we are looking at. And, the timelines are, will come to you when we get there.
And then we wait for that patiently, actually, Sachin. But thank you so much for joining us on the show to talk about the quarter gone by for your company. No doubt the stock is under pressure. That was the management of KPIT Tech saying that they are expecting H2 to be a bit more turbulent. And maybe that's one of the reasons why the stock is under pressure, down about 6.7%. But from one earnings to another, you have Karnataka.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.